So, and the research project is going to be, like I said, it's going to be a little bit different. So there might be some possible unexpected tweaks that somebody might find. It's been done before. I just haven't done it the way that we're going to do it. So I hope to have all that worked out and then give you guys what you're needing to do with it. And so that's why I'm giving you 2 weeks also to work on that. So we'll talk about that at the beginning of class. We'll review, and then we'll be done. So it'll be a shorter class. And the exam is mainly multiple choice, but there will be a couple problem-like questions similar that you see in your homework. But it'll all be in Cengage. Well, we will get going with or without them. All right. So this chapter, I actually kind of like this chapter because while I'm not a huge fan of depreciation, we don't really talk about depletion in class. It doesn't want to be skipped for CPA purposes, but it is, when you look at this chapter for the purpose of the CPA exam, depletion is a smaller portion of it, okay? Depreciation, cost recovery, amortization, we're going to talk about why we would use them in different instances, but depreciation is the much bigger portion of it. I actually like it a lot better because compared to like financial accounting, where you can sit there and say, well, how are you going to do depreciation? You have all these different methods of doing depreciation. In tax, you have charts. You're using specific methods based on the type of property you have, and really the only way you get to decide is whether it's going to be mid-quarter or that is decided based on your value, half-quarter, and then you have a few other decisions. Other than that, you're doing MACRs, which is, I kind of like that aspect for it. So. All right, so we're going back to the doctor, and he has given us a couple things. We're going to refer back to this chart a couple times, only in the form that we're going to refer back to this 91,298. So this number right here. He has these three different things, all different types of office furniture. All this was put into place this year, $612,000, all different, and he filled out his Schedule C, which if you're not familiar with the Schedule C, we've talked about it a couple times. It talks about his business. I'm going to hand you a 4562. It's front and back. This is your depreciation form. I think I've handed out a Schedule C. I can't remember, but I believe I handed out a Schedule C. So this 4562 is a depreciation form, and we're going to kind of go through the details of what's going to be down there under Section 11. All right, we're also going to talk about the special depreciation under Section 2. I said Section 11, I meant Section 3. Section 2, which is special depreciation, and Section 1, which is Section 179. So we're going to touch on all three of those different things. All right, so he came up with that his depreciation expense based on these, and look at these numbers, 14.29 and 20%. Those are numbers that he figured out, and he came up with this 91,298. That is just your basic depreciation numbers that he came up with. And we'll refer back to that. In addition, he has a personal residence that he purchased during the year, which he converted to a business. All right, that actually does happen. He converted it to a rental property. People do that, so we're going to look at how that might affect his taxes. He wants to know if he calculated his depreciation correctly. So we're going to go through and take a look at the different ways that he could have calculated his depreciation. All right, so the first thing is cost recovery. So cost recovery is done in the business for income-producing property. So you have cost recovery or depreciation on intangible assets, depreciable tangible assets, and natural resources. Natural resources are the only thing that we deplete. That's why I said we're not really going to talk much about them in here. And the only businesses that are going to deal with that are businesses that deal with resources that deplete. All right, so natural resources. All other things are going to be either depreciated or amortized. So tangible assets are depreciated, intangible assets are going to be amortized. The nice thing about amortized assets is they're almost always going to be straight line. All right, and there's much easier for straight line. We have different types of property. We have property that includes both realty, which is real property, and I love this word because I never say it right, personality property, but that's personal property. Now, there's a difference between personal property and personal use property. All right. So, realty property usually includes land and buildings. Okay, so the college here and the land that exists on. All right, and so those are usually things that are permanently affixed to the land. So this building is not going to be removed from this land very easily. And then personality is defined as any asset that then goes, that's not realty. So you're usually looking at equipment, and you're looking at the machinery and everything else that goes along when you're thinking of a business. All right? Personality, not personal property, should not be confused with personal use property. So if you're using something for your personal use, that is not what we're talking about, and that is not going to be depreciated. All right? So there is some confusion in there. So we cannot do that. So that's not income producing. And I do get people who will want to get their taxes done that will want to figure out a way to depreciate or use their personal use property, especially in rental income instances. All right, so we have something, general considerations are things that are called like a basis. A basis is an asset is reduced by the amount of the cost recovery. So the basis is usually the amount of what the asset cost at the beginning. As you depreciate and amount that is allowed or not allowed, that is going to actually reduce your basis of that asset. All right. If there is no cost recovery on that claim property, you would still reduce that basis amount. So just because you don't take a cost recovery does not mean that it doesn't affect your basis. So you can't just say 1 year you're not going to take that cost recovery because you don't want it to affect your basis. It would still affect your basis. So one of the things that some individuals don't realize, like when you have a rental property or when you take depreciation, like for example, when you use your home as an office. If you depreciate your home for a home office, you're reducing the basis of your home because you're depreciating your home. So you're taking a tax benefit of your house. So therefore, when you go and sell your house, if you're not taking the exclusion, your basis of your house is getting slightly smaller. So therefore, the gain on your house is getting slightly bigger. So the cost recovery, if you're taking a benefit for tax purposes in cases like this, then the downside is the basis in your asset is getting smaller.
So if you want to sell the house, let's say 5 years later, 10 years later, so you're going to declare more profit on that?
You could declare more profit. Now keep in mind that when you have a house, you get an exclusion, all right, which we'll talk about in the chapter, but you get an exclusion of up to $250,000, all right, on the gain. So you could, that a lot of times people don't even have a gain anymore because they get the exclusion, and you get an exclusion every few years as long as you're not flipping houses, all right? So you have to live in it or have used it to the past 5 years. So most people don't have that. Where you might run into the problem is if you've lived in it, turned it into rental property, and have depreciated it, or if you're using it for business purposes like this. All right. And that's what if personal use assets are converted to business or income producing use, the basis for cost recovery and for loss is going to be the adjusted basis or the fair market value at the time it's converted. All right. So it's going to be the lower, the adjusted basis or the fair market value of that asset. All right. A decline in conversion cannot be recognized for tax purposes. So just because whatever you're converting is lower than what you spent for it at the beginning, you don't get to recognize a loss. That's just a bummer. All right, so another consideration, MACRS, Modified Accelerated Cost Recovery System. You don't have to know what it stands for me, but for anybody that likes tax, you should know what MACRS stands for, all right? So it's a way of accelerated the cost recovery. A lot of people, from a tax perspective, like this, and I'm going to talk about 2 other ways that they accelerate the taxes on their tax for business purposes. Most of the reason people like it on their tax return is because when you go out and you make a big purchase, you spent a lot of money. So the one way to hopefully get a benefit back from that is to be able to write off the depreciation immediately to see the benefit on your tax return right away. And those are a couple of things that you're going to see. So assets have to be used in the trade of business or for production of income. They have to be subject to wear and tear, hence the depreciation. They have to have a determinable useful life. You cannot amortize something or depreciate something if it does not have a useful life, which is why there are only 2 intangible assets that can be amortized. Do you guys know what those are? No, land is not an intangible asset. It's actually,
Patents, I guess.
patent is one of them. A patent is one of them. It's amortized over 20 years or the shorter life. If a patent doesn't, if a patent is not good for 20 years, then you're going to use the shorter. I'll start naming the other intangibles, and you try to tell me if I start get to what the other ones. So we have franchises, all right? We have goodwill. People know what goodwill is? That's what you pay over the fair market value for something. All right. We have intangibles, such as I know I just said intangible. That's intangible. That's not what I'm on. Intellectual property. That's what I was going for. We have copyrights. We have trademarks. We have. I already said no, but I did already say it.
Goodwill is.
No. It's copyright. Copyright is 70 years past the death of the creator, which I know sounds like that's got to be hard to actually amortize, but you don't start amortizing it till it's 70 years after the death of the creator. So that's copyright is amortized in that format. So that's a long time, okay? But a copyright is not anything. That's how long, and that's over books. It's over any type of usually written books, musical, that type of thing is a copyright. Or works of art or different types of things. And then assets that are tangible, personality, or realty. All right, so Dr. Payne, in this instance, had his personal residence, which was $250,000. He found a larger home that he acquired for his personal residence, but because of the downturn in the market, he cannot sell his home and recover his purchase price. His house was appraised at $180,000. So instead of continuing to sell it, he decides to convert it to a rental property. That rental property is going to be, the basis is going to be at $180,000. And that $70,000 that the decline, he does not get to do anything with that. So the basis in that rental property is going to be $180,000. So he still kind of is recognizing, in a sense, a bit of a loss. Because now, I guess he isn't. When he goes to sell that rental property, though, the adjusted basis in that property is now going to be $180,000. So that's going to help him when he sells it, because now it's listed. Now, in his mind, he's still losing money, but the gain will be at a lower amount. Okay, so MACRS. So we have several different classes of life. We have 3, 5, 7, 10, 15, and 20. And 3, 5, 7, and 10, we use what's called double declining, so 200%. It's twice the value we're going to decrease it at, or decline it at. 15 and 20, we use 150, so 1.5 times we're going to depreciate it at the value. And you can use half year or mid-year. All right, double declining can switch to straight line, and then straight line may also be elected at any time. The half-year convention is generally the rule. You treat a service as if it were to be placed in service in the middle of the year. It does not matter when you buy it. It doesn't matter when you get rid of it. You always treat something as if you bought it in the middle of the year. The advantage to this is, or the way that's looked at is, you never really own something for the whole year. So why would you be able to treat it and depreciate it for a whole year? The other thing is, if you remember back to financial accounting, or better yet, if you've had intermediate accounting, to sit there and say that you're going to depreciate something, but you bought it on June 15th, now you're depreciating something for 6.5 months. Well, for a business to go through and do that for every asset, and then the next year do it for a whole year, it's kind of a pain. So tax looks at it and says, it's a half year. Everything you buy is a half year. You just put it in for a half year, then you go for a whole year for the next whatever number of years, and the last year of its life, it's a half year. So it's just a straight year.
Makes sense.
Huh?
Makes sense.
It does make sense, exactly. Now, you purchase land, you place it in service on March 13th. You treat it as if it's June 30th, 6 months. You go for the whole year. The year it's disposed of, it's another 6 months. So it does make some logical sense because the year to dispose of it, for the most part, you're going to use it in that year too. Now there's another one that is called mid-quarter convention. All right, this applies when there's more than 40% of your assets or personality property are placed in during the fourth quarter. And there you got to treat the assets as if they were done in each quarter. So what this is saying is, okay, you had all these assets placed throughout the year, but you went and had, let's say it's $400,000. You had $400,000 put in throughout the year, but $300,000 of it was put in November. Well, you can't treat it as all half your convention and get the benefit of depreciating all of it half year when you put in $300,000 of it in November, which is more than 40%. They're going to make you use something called mid-quarter, and now you got to use percentages based on the quarter, and then everything is based on what quarter it was produced in or purchased in. So I'm going to show you now in the back of chapter 8, and I'm going to put them up here for you. There are numerous pages in your book. They start on page 833, which was on the bottom of that page you just looked at. And they go for 833 to 836. The most commonly used ones are these ones. And this is on page 835. All right. This is 8.5 and 8.6. This is half-year convention for Macker's personal property placed in service, and this is half-year's convention as well. And if I flip it over and go to the next one, on page 8.8, this is the mid-quarter. All right, so if that were to come in, that's mid-month. That's not the one I wanted. Oh, sorry. 8.4 is the mid-quarter. All right, so what I'm going to do now is give you a couple of examples. So if I had an asset that I put in place on 3/28 for $50,000, and I had another asset on 12/28 for $100,000. All right. I did that right. All right. So and they're both 5-year assets. They're both 5-year assets. So thinking about that and what I just told you, you got two different types, and I'm not telling you I put the right slide up there, okay? You got two different types of methods that we can look at, all right? So the first one is half-year convention, which is what I have up there, and then you have mid-quarter. So what did I tell you was the rule for mid-quarter? All right, and what was the percentage? 40%. If more than 40% of your purchases occurred in the fourth quarter, you have to use the mid-quarter. So how much of my purchases occurred? Did more than 40% of my purchases occur in the fourth quarter? Yes, they did. All right, so in this case, I have to use the mid-quarter. So in that case, I have to show you a different one. So you are going to be using this one right here. Let me see if I can blow it up a little bit. All right, so I told you that it was 5-year property. All right. What other information do you? It was placed into service right now, and it was 5-year property. So what do you think you're going to do? This one says 27 and a half year. I think I got the wrong one for you. Let me look. 31 and a half year, 39 year. I do. Hang on. Let me get you the right chart. How about this one? This is a better chart. Okay, let's try this again. It's 5-year property. I was giving you a real estate chart. That was really going to mess you up. It's 5-year property. And so you're actually going to use two different numbers. Which numbers do you think you're going to use? Huh?
How can we guess?
Well, I said you're using 5-year property. So are you going to use the one that says 3-year? 5-year? Yes. You're going to come to this chart. You're in your first year because you just bought the equipment. So year 1, you bought $50,000 in the first quarter. So you're going to take 50,000 times 0.35, and then you bought 100,000 in the fourth quarter. So you're going to multiply it times 0.05. Right? And if the answer would be 17.5 or 17,500, sorry, and 5,000. Now see what the big difference is by doing that? By doing it like that, they're saying you can't go out and buy this ginormous amount in the fourth quarter and get the same benefit as if you bought it in the first quarter where they're getting $17,000 because they're multiplying that number by 35. Here you're going to get a multiply by only 5. Okay, well, if you were doing just the regular half year, this is the regular half year chart. If we would have just been using the regular half year and not mid-quarter, we would have been using 20. So we would have taken 150,000 times 20.2. And so being so fast on my feet with that number, so 150, that would have given us 30,000. Whereas here we're getting 22.5. So we're being reduced by 7,500. So that's the difference between the double declining that way versus here. So that's how the mid-quarter slightly affects. And the more money you have, the more purchases you have in the fourth quarter, the bigger effect it's going to have on you. So half-quarter convention with the double declining is obviously going to have a bigger effect the more that you purchase in that fourth quarter. Well, you will come back to those. Let's go back over here. All right, so those answers are right in the slides. That's why I took you off there. Plus, I want you to be able to read those charts too, because like I flipped to the wrong ones. If you flip to the wrong ones, you're going to have a problem. All right, let's go back. I'm going to go back and do another one. I forgot. So, all right. If we look at the next one, I got to use a different chart. I forgot about that. Let's look at the next chart. The next one says that we're looking at office furniture this time. He wants us to look at his office furniture. He purchased $70,000 of office furniture, $67,000 of computers, and $475,000 of dental equipment. All right. All of it was purchased on September, the office furniture and computer were purchased on September 29th. All right. So we have $70,000. And what was the other amount? $70,000 and that's a weird number, $67,085 purchased on 7/9/29. And then on 10/3, we had $475,000 purchased. All right. So what is that going to make us do again? Are we going back to this chart? And that was that one's easy to tell, right?
Why you don't do that 6 months? 6 months.
When are we going to do a 6 month?
Yeah, doing all these calculations and stuff.
When, you mean as an example, when are we going to do one?
No, I mean the full law. Why didn't you like the first time 6 months you get to amortize and then the last year 6 months?
Well, in these examples we aren't because of how much they're purchasing. They're purchasing so much in the fourth quarter that the mid-quarter comes into effect. So if they would have just stopped, if he would have not made this purchase, if he would have stopped here, then he would be using that half year.
I mean, regardless when we buy, let's say we calculate 6 month depreciation, or that's all.
No, it doesn't, that's not how it works. All right? It
I mean, they made it difficult for us.
Well, no, here's why. And that's not necessarily true. We're going to do it both ways. Okay? Let's do it both ways. So, we're doing it right now. Let's do this way. Let's do what he just said. So, we're doing the 6 month. We're going to treat it as if it was just a half year convention. So, this amount of money he purchased, $475 plus $67,085 plus $70,000 equals $612,085. All right, based on the mid-year convention, the half-year convention, these type of office equipment and everything is okay, they're all slightly different. So office equipment and furniture would fall under they're all going to fall under different ones, of course. So let's put them. We got 1071. All right, so the office, I shouldn't have added them up. The office equipment, if you look up there, is going to be 7 year. The computer is going to be 5 year. And the dental equipment is going to be also 7 year. So the dental equipment and the office equipment could have been added together. So we can add those two together. The dental equipment, these two are both going to be 7 years. So that would be $545,000. This one needs to stay by itself. So this is 7 year. If we're in our first year, what are we going to multiply that by? What was it? 1429? All right, so 0.1429. And the computers are going to be multiplied by 0.20. Which would make sense because computers go much faster. So we take 67085 times 0.2. 67085 times 0.2. That gives us 13,417. And then we're taking the 545,000 times 0.1429. And that's 777,881. Add that all up and we get 91,298. All right, if I remember correctly, that's the number that we had on the slide at the very beginning. 91,298. All right, so that is how he did it. He did his half-year convention. Now let's do it mid-quarter convention. All right? Mid-quarter convention says that our computer, which we just said, was purchased on 9/29. It's a 5 year, so that's the third quarter. So we take 67,085 times 0.15. That's 10,063. Put our 70,000 back up here because that was also in the third quarter. The third quarter of a 7 year, so we're going to take 70,000 times 0.1071. 7,497. And then we'll take 475 times, and this time 475 as a 7 year in the third quarter is 0.0357. 16,958. Add that up. Now, your comment was they're just making it harder, okay? That's a $55,000 difference. And so what the difference besides the fact that that's a $60,000, $55,000 deduction in taxes that they're going to have in their write-offs. They're going to reduce their income by that $55,000. They didn't purchase this equipment until September 29th and October. They didn't use it for all those months. So the law was come up by the fact that if they didn't have this equipment until $475,000 of it until the fourth quarter, why should they get this ginormous tax deduction for the entire year? The way to avoid this very easily, if you want to not have to do it, is that $475,000 equipment. If they would have bought that on 9/29, then they'd be able to use this $90,000. They would have bought that 4 days earlier. They could have done that. Companies know how taxes work. If they don't want to use mid-quarter, then don't buy 40% of your equipment in the fourth quarter. The fourth quarter starts on 10/1. If you buy it on 10/3, then in my mind, as a tax person, you made kind of a dumb decision to buy that much 4 days into the new quarter. That's why I always tell people that if you're going to own your own business, either number one, you have to have a tax person, or number two, you as the owner have to know and understand the tax side. Because sometimes you're a tax person, if they're not involved with your business, they're not giving you enough advice. It's things like this. Don't go buy a whole bunch of equipment in the fourth quarter. You're going to lose $55,000 of tax write-offs. Somebody didn't give Dr. Payne good advice because he missed it by 4 days, and that was not good tax advice. So they're not trying to make it harder, because trust me, whoever's reviewing this tax return, they have it harder too, because they have to actually look at it and review it. So this is what it looks like here. All right. And they actually made the same comment here. Note the implications. If they would have just bought it before October 1st, then the total deduction would have been that $91,000. All right, so quality improvement. So non-residential realty property is 39-year life. And any improvements to that property normally would also have a 39-year life. All right, an exception to that would be quality improvements made, provided for quality improvement. Quality improvement property is recovered over a 15-year life. So this is non-residential. So this is not any type of thing that you're going to live in, or rental property that you're renting out, or any type of rental property that you buy that are like apartment type rental. Those are 27.5 years. And I think you saw in one of the things I already put up. So quality improvements are any type of improvement to the interior, except for elevators. All right, elevators are not included in that. So when the college comes in and does any type of quality improvements on the inside, those are not. Those would be a 15-year improvement. A taxpayer could decide or elect to use straight line rather than accelerated. This is all accelerated depreciation. All right. They use the class life rather than the recovery period. They can use mid-quarter or half-quarter, but the election can be made annually. You would decide to do that if you want to slow down the depreciation. Don't know a lot of people that want to do that, but that would be if you're going to slow down the depreciation over the life of the asset. So this is Dr. Payne, and so they went through and they looked at his cost recovery as if we would do it straight line. All right, so we did it mid-quarter. He originally did it half year. If he were to do it straight line, it would actually fall in between the two. So this is not correct. Half year was not right. This is actually the right way of doing it. Notice if he does it straight line, it actually is higher than if he does it mid-year. All right? He's going to spread it out longer. So Dr. Payne does not elect straight line. His cost recovery would have gone back up to the other. But that's without that, the 475, putting it in the fourth quarter. Okay, and now it says assume the same facts, but he sells his equipment in 2020. His cost recovery for that equipment would be 6709. All right, that's saying he takes this 6705 right here times 0.2, but he sells it in November of next year. He'd only get half of that cost recovery, so that's why it's limited to that 6709. It would be half of that cost recovery. If you sell it halfway through the year, you'd only get half. Okay, so realty property means residential, typically real estate. You have 27 and a half years, all right? And then you also could have non-residential was 31 and a half or 31, which we already talked about. There's straight line and mid-month. Right? And it's residential real estate is where 80% or more gross revenues are from non-transient dwelling units, all right? Examples, apartment buildings. Hotels, motels, and all those, those are not considered what we're talking about. They're considered transient. The mid-month is placed in service anytime during a month is treated as if it was placed in the middle of a month. So a building that's placed in April 25th would be April 15th. There's not a lot of that, but one of your schedules, which was Exhibit 8.8, is mid-month. All right? And that is a lot more work, but that's going down to the detail of putting things into place.